The US housing market is cracking, and in 2025, some cities are about to take a brutal hit. Forget the slow cooling everyone's talking about. These places are staring down double-digit price drops, massive inventory spikes, and sellers slashing tens of thousands off asking prices just to get a bite. Investors are bailing, buyers are disappearing, and mortgage costs are suffocating demand. From Florida's once booming coast to America's hottest pandemic boomtowns, these markets are turning from gold rush to ghost town almost overnight. If you bought at the peak in one of these cities, you might be sitting on a ticking time bomb. Number 10. Oakland, California. Oakland's housing market has been riding a high for over a decade, but 2025 could be the year that bubble deflates. The median home price here currently hovers around $850,000 to $900,000, nearly triple the national average of about $420,000. While Bay Area prices historically resist major drops due to limited inventory, Oakland is in a different position. It's already losing residents to more affordable areas. Census estimates show a population decline of over 3% in recent years, which means fewer buyers and more listings sitting unsold. The affordability gap is staggering. With a 7% mortgage rate, a buyer would need to make roughly $180,000 a year to comfortably afford the median home here. Yet Oakland's median household income sits closer to $90,000. That's a recipe for price cuts. Sellers who bought during the pandemic peak at inflated prices are now facing a market where buyers are cautious and interest rates remain high. Inventory is swelling, with some neighborhoods seeing a 40% increase in listings compared to last year. More supply with fewer qualified buyers usually means price reductions. Even investors are backing off. Rental returns are shrinking as average rents, around $2,600 for a two-bedroom, no longer justify million-dollar purchase prices. The Bay Area tech job market, while still large, isn't the rock-solid safety net it once was. Layoffs and hiring freezes in 2024 left many potential buyers hesitant to commit to a 30-year mortgage. With demand cooling, homes are lingering on the market for 50-plus days on average, a sharp contrast from the 10-day frenzy of 2021. If this trend continues into mid-2025, Oakland could see home values drop 10 to 15%, pushing the median back toward the low 800,000s. For a city where affordability has long been a problem, that's a correction buyers have been waiting for. But sellers may dread. Number 9. Phoenix, Arizona. Phoenix was once America's bargain desert oasis, but 2025 could turn it into the poster child for a brutal housing reversal. Between 2019 and 2022, home prices here skyrocketed nearly 60%, pushing the median from around $280,000 to over $450,000. Investors flooded in, scooping up entire neighborhoods, betting on endless growth. But that growth is now stalling, and the cracks are showing fast. With mortgage rates hovering at 7%, monthly payments for a median Phoenix home are up nearly $900 compared to just 3 years ago. That's pricing out thousands of would-be buyers. Meanwhile, Phoenix's construction boom, one of the largest in the nation, is delivering more inventory than the market can swallow. Some suburbs are reporting a 70% jump in active listings compared to last year, giving buyers unprecedented bargaining power. The investor pullback is the real gut punch. Phoenix was a top iBuyer and short-term rental hotspot, but now many of those properties are sitting vacant or listed for less than they were bought for in 2021. Zillow flips? Some are underwater by $50,000 plus. Airbnb bookings? Down sharply, leaving owners with costly vacancies. Add in the scorching summers. 2024 saw a record 55 days over 110 degrees Fahrenheit. And the migration surge that fueled the boom is slowing. Out-of-state buyers from California and the Midwest aren't as eager when cooling bills top $500 a month and home insurance premiums climb due to extreme weather risk. If trends hold, Phoenix could see a 15 to 20% price drop in 2025, especially in fast-built fringe suburbs where values were inflated by speculative buying. This won't just be a cooling. It could be a desert housing drought where sellers slash prices to survive. Number 8. West Palm Beach, Florida. For years, West Palm Beach was a magnet for wealthy transplants fleeing high-tax states, but 2025 could mark a sobering reversal. Prices here exploded over 50% in just 4 years, with the median now topping $500,000. That's luxury-level pricing for a city where the median household income is just $64,000. The affordability gap is staggering. At today's mortgage rates, a buyer would need nearly $120,000 annual income to afford the median home, meaning locals are getting completely priced out. Who's been buying? Mostly out-of-state investors and retirees. But that pool is drying up fast as insurance costs go nuclear. In coastal Florida, premiums can now exceed $8,000 a year, and some carriers are leaving the market entirely. The condo market is particularly vulnerable. Many older buildings are facing massive special assessments after Florida's post-Surfside safety reforms. Some owners are staring at repair bills of $50,000 to $100,000, forcing panic sales. Add in HOA dues that can hit $1,000 a month, and even cash buyers are rethinking their Sunshine State dream. Inventory is climbing, up 35% year over year, and luxury listings over $1 million are lingering on the market for months. Investors who counted on Airbnb income are seeing occupancy rates drop as Florida's vacation rental market becomes oversaturated. If interest rates stay high and insurance woes continue, West Palm Beach could see a 10 to 15% price drop in 2025, with condos and waterfront properties hit hardest. This isn't just a price adjustment, it's a reality check for one of Florida's most hyped boom markets. Number 7. Jacksonville, Florida. Jacksonville was Florida's affordable big city. Emphasis on was. In just 5 years, median home prices jumped from $220,000 to over $360,000, outpacing wage growth by a mile. That surge, fueled by pandemic migration and investor frenzy, is now looking dangerously top-heavy. One of the biggest red flags? Jacksonville's rapid new construction. Developers have been building at a pace rarely seen here, adding thousands of new homes and rentals to the market. With interest rates high, many of those homes are sitting unsold, and some builders are offering $20,000 plus in buyer incentives just to move inventory. Property insurance is another ticking time bomb. Florida's statewide insurance crisis has hit Jacksonville hard, with premiums up 40 to 60% in the past 2 years. For a typical $350,000 home, that's an extra $2,000 to $3,000 a year before you even touch the mortgage. Jacksonville's rental market, once a cash cow for investors, is softening, with rent growth slowing to under 2% annually while vacancies rise. Investors who bought at peak pricing in 2021 and 2022 are now struggling to cover costs, especially with rising maintenance and tax bills. Inventory is swelling, up nearly 50% compared to last year, and homes are sitting on the market twice as long as they did during the boom. If buyer demand doesn't rebound, Jacksonville could face a 12 to 18% price drop in 2025, especially in new-build suburbs and investor-heavy neighborhoods. For a city that once sold itself as affordable Florida, the housing crash here could be one of the state's most surprising and fastest. Number 6. Las Vegas, Nevada. Las Vegas is no stranger to housing booms and busts. It was ground zero for the 2008 crash, and 2025 could be déjà vu. Over the past 5 years, home prices surged more than 50%, with the median now around $430,000, far above its pre-pandemic level of roughly $280,000. But cracks are spreading fast. High interest rates have hit Vegas harder than most cities because so many buyers here are investors or second home seekers. At 7% mortgage rates, monthly payments on the median home have jumped from about $1,300 in 2019 to well over $2,700 in 2025, doubling in just a few years. That's forcing many would-be buyers out of the game entirely. Inventory is swelling. Active listings are up 60% year over year, and homes that once sparked bidding wars are now sitting unsold for 60 to 90 days. Many investors who bought at peak pricing for Airbnb rentals are finding the short-term market oversaturated. With visitor numbers flattening and new vacation rental restrictions, nightly rates have dropped, slashing profitability. Las Vegas is also facing a wave of price cuts and sprawling new subdivisions built on the city's outskirts. Builders are offering up to $40,000 in incentives, free upgrades, and even mortgage rate buydowns just to keep deals alive. That kind of desperation is a classic warning sign. The city's job market is heavily tied to tourism and conventions, both of which are sensitive to economic downturns. If the U.S. economy slows, layoffs in hospitality could further reduce buyer demand. By late 2025, Las Vegas could see 15 to 20% price declines, especially in investor-heavy neighborhoods and overbuilt suburbs. For locals priced out during the boom, that drop could be a lifeline. But for recent buyers, it could mean instant negative equity. Number 5. Tampa, Florida. Tampa's housing market has been on fire since the pandemic, but 2025 could be when the flames burn out. Between 2019 and 2023, Tampa's median home price jumped nearly 65%, hitting around $420,000. That's huge growth for a metro, where the median household income is just $70,000, leaving affordability stretched to the breaking point. Florida's ongoing insurance crisis is hitting Tampa homeowners hard. Premiums that were once $2,500 annually are now pushing $6,000 to $8,000, especially for homes near the coast. Some insurers have exited the market altogether, forcing buyers into more expensive state-run policies. This has become a deal-breaker for many prospective buyers. Inventory is climbing, up more than 35% year-over-year, and homes are taking twice as long to sell compared to the frenzy of 2021. Many sellers who bought at peak pricing are facing the harsh reality of reducing their asking price by $20,000 to $50,000 just to attract offers. Tampa's investor-driven boom is also showing strain. During the pandemic, Wall Street firms and short-term rental investors flooded the market. But now, with rent growth slowing and vacancies rising, many are unloading properties at discounted prices. Add to this a slowdown in in-migration. Tampa's pandemic-era surge of remote workers from New York, Chicago, and California is tapering off. With fewer buyers and higher costs, demand is cooling quickly. If interest rates stay high and insurance premiums keep climbing, Tampa could see 12 to 18% price declines in 2025, with the steepest drops in coastal and investor-heavy neighborhoods. Number 4. Nashville, Tennessee. Nashville was the darling of the pandemic migration boom, and that's exactly why it's now at risk of a sharp correction. From 2019 to 2023, the median home price soared from around $295,000 to nearly $460,000. A staggering 55% jump in just 4 years. The problem? Nashville's price surge far outpaced income growth. The city's median household income is around $75,000, meaning the average family would need to spend over 40% of their income just to afford the median home at current rates. That's a red flag for sustainability. Inventory is rising fast, especially in newly built suburbs like Mount Juliet and Murfreesboro, where developers cranked out homes to meet pandemic demand. Many of these properties are now sitting on the market for 60-plus days, with builders offering $25,000 to $50,000 in incentives to attract buyers. Nashville's rental market, which drew in a wave of investors, is also cooling. Rent growth has slowed to under 2% annually, and vacancies are rising as more apartment complexes flood the market. Short-term rental profits are being squeezed as stricter city regulations limit Airbnb operations. The Music City's job market, while still strong in healthcare and entertainment, isn't immune to broader economic slowdowns. If hiring slows in 2025, demand for housing could take another hit. With these factors aligning, Nashville could see 10 to 15% price drops in 2025, especially in investor-heavy and overbuilt suburban areas. For a city that was once the hottest real estate story in the South, this could be a sobering reality check. Number 3. Miami, Florida. Miami has been one of the hottest and most overhyped housing markets in the U.S., but in 2025, it could turn ice cold. The median home price has exploded from roughly $350,000 in 2019 to well over $570,000 today, a 60% jump in just a few years. That kind of growth is unsustainable in a city where the median household income hovers around $57,000. The affordability crisis is at breaking point. At current 7% mortgage rates, buyers need to earn $120,000 plus to comfortably afford the median Miami home. That's more than double what the average household brings in. Unsurprisingly, local buyers are being replaced by wealthy transplants and investors, but even they are starting to balk. Florida's insurance nightmare is hitting Miami especially hard. Waterfront and storm-prone areas can see annual premiums over $10,000 to $15,000, and that's before factoring in flood insurance, which can add $3,000 to $5,000 a year. Condo owners face another ticking time bomb: post-Surfside building regulations requiring costly repairs and safety upgrades. Special assessments ranging from $50,000 to $150,000 per unit are forcing fire sales in older high-rises. Inventory is climbing, up nearly 40% year over year, and luxury condos, once snapped up in days, are now sitting on the market for months. International buyers from Latin America, a major source of Miami's demand, are pulling back due to currency fluctuations and economic troubles in their home countries. If these pressures persist, Miami could see 12 to 18% price declines in 2025, with luxury and waterfront properties taking the hardest hit. For a city that marketed itself as a can't-lose investment, the coming year could be a harsh reality check. Number 2. Austin, Texas. Austin's rise from quirky college town to tech mecca is one of America's biggest housing stories. But the crash that may follow could be just as dramatic. From 2019 to 2022, the median home price rocketed from about $320,000 to over $550,000, a jaw-dropping 70% increase. Even after a slight dip in 2023, prices remain massively inflated compared to pre-pandemic levels. The problem? Austin's growth was fueled by an influx of remote workers and tech employees, many bringing California-sized budgets. But with interest rates high and tech layoffs making headlines, demand is softening fast. Inventory has surged 50% year over year, and homes that once sparked bidding wars are sitting for 60-plus days, forcing sellers to slash prices by $25,000 to $75,000. Affordability is in freefall. At 7% mortgage rates, buyers need around $120,000 annual income to afford the median Austin home, yet the city's median household income is closer to $85,000. That gap is pushing locals out of the market and cooling relocation demand. The investor retreat is making things worse. Austin was a short-term rental hotspot, but with occupancy rates falling and new regulations tightening, many owners are cashing out, even at a loss. New construction, especially in sprawling suburban developments, is adding to supply and putting more pressure on prices. By late 2025, Austin could see 15 to 20% declines, especially in outer suburbs and investor-heavy neighborhoods. For a city once hailed as bulletproof, this could be its first true housing reckoning in decades. Number 1. Cape Coral, Florida. Cape Coral was one of Florida's fastest rising stars during the pandemic housing boom, and that's exactly why it's now sitting on a cliff's edge in 2025. Between 2019 and 2022, the median home price here exploded from roughly $230,000 to over $420,000, an 80% surge that lured investors, retirees, and remote workers in droves. But that kind of parabolic growth never lasts, and the slowdown has already begun. The city's affordability problem is glaring. At today's 7% mortgage rates, the monthly payment on the median home now hovers around $2,800, not including Florida's crushing property insurance bills. In Cape Coral, premiums can run $6,000 to $10,000 a year, and flood insurance can tack on another $3,000 to $5,000. For many buyers, the math simply doesn't work. Inventory is swelling at one of the fastest rates in the state, up more than 60% year over year. Waterfront properties that once ignited bidding wars are now sitting unsold for months, with price cuts of $50,000 to $100,000 becoming common. New construction, which boomed during the migration surge, is adding even more pressure. many builders are offering tens of thousands in incentives just to close deals. The investor retreat is accelerating the downturn. Cape Coral was a prime Airbnb hotspot, but with vacation rental demand cooling and increased competition from nearby Fort Myers, many owners are finding returns far lower than projected. Some are now unloading properties at break-even or losses. Hurricane risk is another wild card. After Ian's devastation in 2022, buyers are far more cautious, and some lenders are tightening requirements for high-risk coastal homes. That extra layer of risk is pushing some would-be buyers inland. If trends hold, Cape Coral could see 15 to 20% price declines in 2025, making it one of Florida's most dramatic housing corrections. For sellers who bought at the peak, the hit could be painful, but for patient buyers, it could be the buying opportunity of the decade.